What's happening, B2B fam? Michael T. Ragland here, and in today's video, we're gonna get right to it. I know everybody's talking about Nvidia and Apple and all these big companies, but for most of us, we've missed the wave on those companies. So what I wanna do is give you 3 companies that are actually nearby levels that have crazy strong balance sheets and some other pretty cool metrics that make them a fantastic long-term investment for your portfolio. So the first one we're gonna look at is called ResMed. ResMed is a global leader in the development and manufacturing of cloud connected devices for people with sleep apnea, COPD, and other chronic diseases. Like, I know all of us have somebody that be up in the bed next to us, or that we notice like, I BS you not, when I was in the military, I had a dude that was like a reservist who was a New York City police officer, and he was in the same bunk as me, and this dude just snored up the whole night, and he'd like wake up like almost like drowning in his own saliva or whatever it was. And I was like, what the hell is wrong with you, bro? And he's like, oh, I have sleep apnea. And that's the first thing I've heard of it. And I think a lot of us know about sleep apnea now, and COPD as well, which is a respiratory disease. So this is a super important company, but I love it because it's taking medical and putting their tech and using cloud connected devices to really monitor these people's breathing and symptoms. And it's a great company because we can look at the PE ratio of 29.09. The PE ratio is just a valuation. For me, I like to see things as low as possible, like usually at anything 20 or below. Even something that's like 29 like this is awesome as well, but we'll get to the buy levels in a second. And it has a market cap of around $27.8 billion. So it's a super solid player in the healthcare sector. But let's jump straight to the buy level. So right now, ResMed is trading at $189.40. And the key buy levels that I'm looking at, write these down. These are 3 levels that I'm looking at: 178.26, 169.50, and 160. So what that means is that even though I'm excited about this company and I know that it's a great long-term investment, I want to go in and buy something for as cheap as possible so I can ride it on the upside. One mistake that a lot of people make is that they're like, hey, I love this company, I'm buying right now, and then it automatically pulls back. There's a lot of people I talk to like, hey man, why things always dip when I buy them? That's because you're buying at the wrong price. So just by doing some very simple technical analysis and using fibs and some other super simple tools, you can go in and find those key support levels. So we're at 189.40. I needed to see it come down closer to 180 or 178.26 is my first level to buy. When I talk about 160, well, if I see it go to 160, I'm loading the boat and buying as much as I can as possible. Because remember, it's a strong company. And I like to use leap options, which give me the opportunity to buy 100 shares a year from now, right? We'll get into that in a separate video. I can't remember if I covered it before, but go look in the channel to see what leap options are all about. And that's how I like to buy these things, but I'm okay. If it hits 178.26, I'm okay with buying as well. But let's talk a little bit more about why I'm bullish on ResMed. Like I said before, like we got all these sleep orders and respiratory diseases going around. There's always going to be a demand, and then they're innovative by using cloud connecting solutions as well. And then we jump into some of the financials that's just out of this world. So that gross margin is 56.51. So what a gross margin really means is the percentage of revenue exceeds the cost of goods. So pretty simple, right? So the way to kind of break this down, just for people who still don't understand, is like, okay, let's say that I sell t-shirts. Well, if I sell those t-shirts, which I've done before, I need to pay the manufacturer a price for that t-shirt and then just sell it to you. How much more can I mark up a t-shirt before it's like too expensive for you to buy, right? That's why the t-shirt business is not a good business. But things like technology are. So what this means is that it costs them a certain amount to buy something, they can sell it for a lot more. And that gives us that gross margin, with this 56.51%. The difference between how much it costs me to buy it and what I sell it for. So 56.51% markup technically on this. So great gross margins, right? And then we have a EBITDA margin of 31.44%. So EBITDA is one of those weird words, but it's very important when it comes to evaluating a company. So that is earnings before interest, taxes, depreciation, and amortization. And this shows how well the company is operating before all of those expenses, right? A high EBITDA just means that a company is very efficient in their cost management. And then we have a return of assets of 13.42%. This measures how efficiently a company uses assets to generate profits for us, right? The shareholder. The higher that ROA, the better the company is at converting its investments into net income. And then we have a return on equity of 22.71%. And once again, this just measures your profitability relative to shareholders' equity. So a high ROE indicates that the company is effective at generating profits for shareholders' investment. If I go back one, ROA is the return on the actual assets that the company has, and that was 13.42%. ROE is the return on the equity, right? That's the shareholders' equity for me and you, which is 22.71%. Sorry for that flub up before. It's a bit early and I'm sick. Sorry. But that's ROA and ROE. Bottom line is that they are great companies. And I absolutely love data. So I actually want to share something that's pretty interesting with you. So let's actually look at the revenue per employee for ResMed. So if you look at this, this is in millions, by the way. So 1,000 million is a billion in the case of this chart. So looking at the chart here, at the last one we have data for both, which is last year, 4.223 billion in revenue for that year. And then if we go all the way down here, it's showing us the revenue per employee. It's in millions as well. So 0.5 is half a million. So $500,000 per employee with 4.2 billion in revenue just shows how efficient this company is and the huge gap in that operating flow for this company. So I know a lot of companies, a lot of people don't like to see this because you're like, wait a minute, they're making 500,000 for an employee. I make 40,000 and they're making 4 billion. But remember, we're not thinking like an employee. We're thinking like investors now. So I love to see this. I'm like, this company is super efficient at making money. And that's what matters when you're investing in something. All right, the next one we're going to talk about is VeriSign, ticker symbol VRSN. So what VeriSign does is they provide that domain name registry, you know, like .com, .edu, etc. services, but more importantly, they actually provide the infrastructure behind the internet, which is insane, right? So if you're a tech nerd like me, you probably seen things like secured by VeriSign or something along those lines. They've been around so long, they probably own most of their infrastructure for the freaking internet, and they're able to make a ton of money by leasing and renting and selling those domain names. So anytime anybody buys a website or renews domains, this company VeriSign makes money off of it. And they have that PE ratio right now of 21.57 and a market cap of 17.5 billion. Remember, that PE ratio just states what the valuation is, and the lower the better. Close to 20 is good with me. 21.57 is pretty daggum good for valuation for a company this important. Let's jump right into the key levels that I want to buy this at. It's at 175.45 right now. That first level I needed to come down to before I would be interested in buying it at a discount is 170, and then we have $10 increments after that. 160 and 150 are those three levels that I'm interested in buying VeriSign at. Remember, don't just jump in and buy something right now. Get it at its lowest price as possible. But something like VeriSign, I know I'm keeping it a long time, so I really don't mind paying $5 more because I'm investing and holding it for the long term. It's one of my draft picks, if you will. But still, I'm waiting till it hits at least 170, 160, 150. At 150, I'm loading the boat and selling everything to buy more in this case. And like I said at the beginning, I'm super bullish on it because of the growing importance of internet security and freaking domain names. We know the internet's not going anywhere. There may be different iterations of it, but everybody's going to always be going to .com domains for something. So those services are going to continue to be in great demand for VeriSign. But don't just take my word for it. Let's look at some of these financial metrics. So a gross margin of 87.1%. Like I said before, this is how much the company makes after accounting for cost of goods, which lets me know that they already own that infrastructure or have some great deals with data centers or wherever else the infrastructure is housed to make a ridiculous gross margin like this. And this is what you benefit from investing in companies that have been around with forever and are super important. In the EBITDA margin of 70.09%. Remember, this is just earnings before interest, tax, depreciation, and amortization. That's all EBITDA is. A very important valuation metrics that let me know that a company is operating super good. Then a return on assets of 40%, which is high as well, using those assets to generate plenty of profit. Then another term that I didn't talk about before in the last one that I was evaluating is going to be return on invested capital of 50%. So this is going to measure the return generated on any of the capital investments. A company buys something or spends money on it, they're going to get 50.4 out of that, which is super great. This shows that they're very efficient at using the capital that they invest into things. It's a super important metric that a lot of people overlook, and I like it because it's a very pure metric to evaluate how efficient a company is at operating. So the higher, the better. So for sake of reference, I think the ROC for the top 500 or S&P 500 companies was around 29%. Last year, this company is at 50%. So crazy good at using that operating money. And I want to show you something very simple at how to evaluate a company and what I talked about before. We're going to look at total revenue versus the cost of goods for companies. So if you're looking at VeriSign, that total revenue year to date is 1.5 billion. It costs them 196.5 million for their actual cost of goods, which is fan-freaking-tastic. Like, look at that huge gap in between. That's why those operating margins are out of this world. And these are simple things you want to look at when you're evaluating a company. Like, don't just follow what I say or any other online influencer talks about. Like, just look at the data. It's super simple. How much money are you bringing in? How much is it costing you to actually make a profit? That's total revenue versus cost of goods. And this is next level. 1.5 billion, 196 million to keep things running to make your money. Mwah. Love it. Super great. The next one we're going to dive into is a real estate investment trust, or REIT. This one is ticker symbol VICI. I love this because this REIT actually specializes in gaming, hospitality, and entertainment. We know how much we love to have our fun, but look at this PE ratio, 11.01 at a market cap of 28.9 billion. So just at that simple metric alone is letting me know that this thing is crazy undervalued. I know it's probably because they're not huge growth stocks, but if you want a place to park your money, not financial advice, do your own research, but REITs are great for that because they also give you some amazing dividends. Like, they're bound by law to give out dividends, which is another story. But VICI is currently trading at around $27.69, and the levels that I needed to drop to before I'm interested in buying is 26.63, 25, and 23.50. That's 3 different levels. Remember to write those levels down on all of these things and go look at your charts to try to understand why I'm doing that. I want to buy at a discount, even though it is a great company. A gross margin of 99%. This is just nuts. I mean, all of their revenue except for 1% is retained. I'm going to show you on the chart in a second how they do that. EBITDA margin of 92.67%, return on equity of 8.42%, and ROC of 6.97%. Remember, this is crazy because this company actually owns casinos in Vegas and around the world. I think they're mostly in the States. They just recently went international, I think to Canada first. But they own these places and they're still returning 8 to 6% on that invested capital and on that equity, which is insane. It's not going to be as huge as some of those other internet companies or companies that don't have casinos and huge buildings that they own, but this is fantastic for REITs. Just compare it with some of the other REITs out there. It is absolutely crushing them. But let's actually jump into how REITs make money. So, like I said before, they lease or rent out buildings to tenants. Tenants like your Walmart, Amazon warehouses. In the case of this company, actual casinos and huge buildings and venues they lease out. So, for example, if we go in and look at what the orange is showing us, it's showing us year to date, they've made over $2 billion in sales type leases. I want to explain what this actually means. So, what you don't know is, like, say you go to Walmart or one of these companies, they actually lease that from one of these real estate investment trusts, but the lease is like a sale because it's like a 99-year lease, right? So you're gonna pay a lot more to have a 99-year lease, but you're gonna be taking on a lot of the risk of operating and running that actual building. Technically is yours, right? In this case, but VICI still gets interest and money off of that lease that they've given to you. So if you notice this company, they're super smart because they shifted a lot of their business to those type of leases because they're a lot more profitable and they benefit on the upside with not as much of the downside. And then the next level down is at 1.5 billion off of the lease receivables. This is just a straight up lease. You know, I'm gonna sign you to a 5-10 year, whatever lease to go into this building, but I still own it and you're gonna pay me for that business. And then of course the other one is the operating leases, which is more like a rental, right? And you make money from that and I get interest and so on and so forth from that. So that is how REITs make their actual money, and this is how profitable VICI has been, and this is why they have an almost daggum 99% profit margin. So there you have it, guys. Let me know in the comments what you think about these type of videos. Like, I always want to teach you how to fish instead of giving you the answers, but I think it's super important to give you something tangible and actionable to go and invest in. Remember, I'm not a financial advisor. Do your own research to validate these support levels that I'm giving you, but this is how you break down the company. I'm gonna continue to do these to show you why it's important to know what you're looking at from a financial and operational perspective, because we are all about going from broke to breakthrough, because I want you to be able to leave behind more than just debt to your family when you die. And if you really love this video, check out this one right here because it is a banger as well. Until next time, it's your boy Michael T. Ragland. I am out. Peace.